Did you know that right now, a Wall Street fund's mechanical liquidation has accidentally created one of the most explosive short squeeze setups of 2026? We're talking about a stock where over a quarter of the tradable shares are actively betting against it, even as the company just locked in $2.8 billion in guaranteed revenue. In today's video, we're breaking down why Wall Street is calling for a 111% upside on IREN, why the price target for the coming weeks has analysts buzzing, and the single hidden metric that could change this entire story. Welcome back. Today we are tearing apart the brutal high-stakes battleground of IREN. And while the short squeeze potential is insane, there is one hidden metric regarding their debt that changes everything, and we'll get to that in just a few minutes. Real quick, if you love deep dives like this one, do me a favor and tap that like button and subscribe. It genuinely helps the channel more than you know. Now, let's get into it. To understand why this thing is a coiled spring, we have to look at the massive disconnect between what the market thinks is happening and what is actually happening. Let's lay out the four pillars of what makes IREN so unique right now. First, the setup, a staggering 27.6% short interest. That is a massive powder keg of traders betting the stock will fail. Second, the pivot. IREN is executing a massive transformation from a pure-play Bitcoin miner into a highly scarce AI cloud infrastructure leader. Third, the validation. They just inked $2.8 billion in AI cloud contracts. And finally, the upside. Wall Street analysts are currently projecting an implied upside of over 111%. But wait, if the upside is so high and the contracts are signed, why did the stock just lose nearly half its value in a matter of weeks? If we dig deeper into the actual numbers, we uncover a story of panic, margin calls, and an unnatural market crash. Back on July 27th, I warned you guys that IREN was a high beta battleground. I said if it broke support at $34.30, we could see a total washout into the 20s. And boy did we get exactly that. Between July 27th and July 29th, the stock went into a free fall, bottoming out perfectly at $29.31. I initially predicted this would happen because of a fundamental macro shift, maybe big tech pulling back on compute spending, or IREN missing their hardware deadlines. I was wrong about the catalyst. The brutal plunge to $29 wasn't because IREN's business was failing. The reality of why it fell is much crazier. It was a mechanical crash. A fund called Situational Awareness, run by Leopold Aschenbrenner and leveraged 4-to-1, faced critical margin limits. When a hawkish Fed and geopolitical shocks hit the market, this fund was forced into involuntary liquidation. They had to blindly dump a $401 million position in IREN on the open market. This was unnatural selling pressure. It wasn't fundamentally driven. It was a forced fire sale. But that's only half the story. Because what happens when an artificial weight is suddenly lifted off a spring? It snaps back violently. Once that massive $401 million block of liquidated shares was fully dumped, the institutional giant Citadel actually stepped in to absorb the remaining block. The second that unnatural selling pressure was removed, IREN staged a massive, violent 30.5% snapback on July 30th. It closed out the day at $38.26 on trading volume that was 68% above average. By August 3rd, it climbed even further to $39.06. This wasn't a dead cat bounce. This was the market realizing the floor at $29 was artificially created by a margin call, not a broken business model. Now, none of this matters if we don't look at the fuel that's currently trapped inside this stock. Enter the short sellers. My previous analysis highlighted a 22% short interest. Well, it's gotten even more explosive. Recent data shows short interest just spiked by another 23%. Right now, there are 93.71 million shares sold short, representing a jaw-dropping 27.61% of the public float. The 30% rally we just saw on July 30th? That was likely just the very beginning of a short covering cycle. With over a quarter of the tradable shares betting against the company, any major piece of good news is going to trap these shorts, forcing them to buy back the stock at any price to cover their positions. It's the exact recipe for a face-ripping short squeeze. So, where exactly does this explosion happen on the charts? Let's look at the technical battleground. We now have a proven structural hard floor between $29 and $32, validated by that massive margin call absorption. But the trigger you need to watch is $42.70. A high-volume push through this specific level signals to the market that all the liquidated inventory from that margin call is completely gone. If it breaks $42.70, it threatens a major technical resistance at $48. Breaking that $48 ceiling is what traps the shorts and triggers the massive squeeze we've been tracking. But technicals are just lines on a chart without the fundamentals to back them up. So let's look at what the company is actually building. IREN is undergoing one of the most aggressive pivots in the market right now. They are transforming from a pure-play Bitcoin mining operation, which is highly volatile and entirely dependent on crypto prices, into a vertically integrated AI cloud infrastructure leader. And they have an ultimate trump card: highly scarce, grid-connected power capacities that even the biggest mega-cap tech companies cannot easily replicate in the near term. However, building data centers isn't cheap, and that brings us to the biggest fear every IREN bear has been screaming about: the dilution trap. This is the hidden metric I promised you earlier. The bear thesis on IREN is that they will have to aggressively dilute shareholders, meaning issue millions of new shares just to fund massive data center buildouts. And they have issued convertible notes to survive the cash burn. But here is the reality the bears are missing. IREN's new multi-year cloud contracts mandate massive customer prepayments. These prepayments are covering roughly 45% of the related GPU capital expenditures. This completely changes the math. By getting the customers to front almost half the bill for the hardware, IREN drastically mitigates the need for external equity financing. They are funding their growth with their customers' cash, not just yours. And speaking of those customers, exactly how much revenue are we talking about here? We are talking about a gargantuan $4 billion annualized run rate revenue target for 2026. On July 30th, co-CEO Daniel Roberts confirmed that demand is vastly outstripping their physical supply. Right now, there are thousands of workers on site pouring concrete and racking GPUs as fast as humanly possible. Why? Because 85% of that $4 billion target is already locked in, and they aren't signing contracts with nobody's startups. This $2.8 billion in new AI cloud contracts comes from the absolute kings of the industry: Microsoft, NVIDIA, Perplexity, and Figure AI. Securing capacity agreements with the world's leading hyperscalers doesn't just validate IREN's pivot, it guarantees high visibility, recurring cash flow for years. Which leads us to the sheer scale of what they are attempting to build. This is the megawatt roadmap, and it is staggering. Just 1 year ago, IREN had a measly 3 megawatts of AI cloud capacity. By the end of 2026, their near-term target is a massive 480 megawatts. But the real prize, the long-term target for 2027, is a mind-bending 1.2 gigawatts of highly scarce, grid-connected power. In an era where AI needs electricity more than anything else, possessing 1.2 gigawatts of capacity makes IREN an incredibly valuable, borderline irreplaceable asset. So, what is all this actually worth according to the smartest money on Wall Street? The street firmly agrees with this bullish outlook. The consensus rating across Wall Street is a moderate buy, with an average 12-month price target of $82.71. Based on the August 3rd close of $39.06, that implies an incredible upside potential of over 111%. But the top-tier analysts see even more room to run. H.C. Wainwright recently raised their target to $90. Cantor Fitzgerald listed as overweight with a $99 target. And Bernstein maintains a $100 bull case target, predicting a massive re-rating of the stock once IREN proves their AI cloud ramp is being executed on schedule. So with a $100 bull case and a proven floor in the high 20s, how exactly should you be playing this right now? Here is your investor playbook, broken down for both swing traders and long-term holders. For the short-term swing traders, your entire universe revolves around the August 27th earnings report. The strategy here is an asymmetric risk-to-reward setup. You are watching that $42.70 breakout level like a hawk. If they beat revenue conversion metrics on the 27th and push through $42.70 on high volume, that is your signal that the short squeeze initiation sequence has begun. For the long-term holders, your catalyst isn't this month, it's the 1.2 gigawatt roadmap transition in 2026 and 2027. Your strategy is to stomach the high beta volatility and aggressively accumulate on macro-driven dips. You are focusing entirely on the horizon when that projected annualized run rate finally converts into billions in recognized, cold hard cash flow. Which brings us to the final verdict on why IREN sits exactly where it does today. IREN presents an exceptionally rare strong buy opportunity, created by a perfect storm of 3 converging factors. Number 1, mechanical price suppression. A forced liquidation created an artificial, deeply discounted entry point that had nothing to do with the company's fundamentals. Number 2, a 27.6% short interest. This provides explosive squeeze potential the moment shorts are forced to cover. And number 3, $2.8 billion in locked blue-chip contracts. This guarantees the fundamental growth needed to trap those shorts and fund the expansion. It is the perfect marriage of a technical coiled spring and undeniable fundamental execution. Now, before we wrap up, a quick but important disclaimer. Everything in this video is for educational and entertainment purposes only. I am not a financial advisor, and this is not financial advice. IREN is a high beta asset. It will be volatile, and real execution risks remain. Please always do your own research and consult a licensed professional before making any investment decisions. Never invest money you can't afford to lose. With that said, here's my final take. If management delivers on these contracts and this roadmap, the upside is genuinely massive. But the market rarely hands you a setup this asymmetric without a reason to be cautious. So now I want to hear from you. Do you think IREN blasts through that $48 resistance and triggers the full short squeeze before the end of the year? Or do you think the bears have one more washout left in them? Drop your price target in the comments below. I read every single one. And if this breakdown gave you a fresh edge on this stock, smash that like button and subscribe so you never miss the next deep dive. I'll see you in the next